Hello everyone, and welcome back to MBA 605 Auditing. During today's session, we want to talk about the overall audit strategy and audit program used in one of the phases of the audit process. This is a critical step because it's during this step that we establish the audit strategy and the audit program that we plan to follow. And that includes all the audit procedures, the sample sizes, the items to test, and the timing of this testing. And so today we'll talk about the 5 types of audit tests to determine whether financial statements are fairly stated. We'll talk about how to select the appropriate types of audit tests to use in our program. We'll understand and discuss some of how information technology affects our audit testing, and we'll understand the concept of evidence mix and how it should be varied in different circumstances. We'll also design an audit program. We'll compare and contrast transaction-related audit objectives with balance-related and presentation and disclosure-related audit objectives. And then we'll integrate the 4 phases of the audit process that we've been building up to this point in the program. And so, in developing the overall audit strategy, auditors use 5 types of tests to determine whether financial statements are fairly stated. We use risk assessment procedures to assess the risk of material misstatement, represented by the combination of inherent risk and control risk. And we talked about inherent risk in a prior chapter. It deals with the business line that the client is engaged in. And as we discussed, there are some business lines that just have more inherent risk. The transactions are more complicated, they're more sophisticated, they require more management estimates, versus other business lines that have more established and routine transaction levels that cause the inherent risk to be lower. And then we talk about this idea of control risk. If you recall from a previous session, control risk measures the auditor's assessment of the risk that a material misstatement could occur in an assertion and not be prevented or detected on a timely basis by the client's internal controls. So if we assess control risk high, then we assess our testing low. Control risk and testing are have an inverse relationship with one another. And so this idea of inherent risk and control risk help us to determine our risk assessment procedures. We then move on to test of controls. The auditor's understanding of internal controls is used to assess control risk for each transaction-related audit objectives. To obtain sufficient appropriate evidence to support the assessment, the auditor performs tests of controls. And these tests of controls could include inquiries of appropriate client personnel, examination of documents, records, and reports, observation of control-related activities, and reperformance of client procedures. As you recall, each of these tests that we talked about were all types of evidence gathering, dealing with inquiry, examination, observation, or reperformance. The third type of test is substantive test of transactions. And these are tests of procedures designed to test for dollar misstatements, also called monetary misstatements, that directly affect the correctness of financial statement balances. Substantive tests of transactions are used to determine whether the 6 transaction-related audit objectives, if you recall, these are management assertions about account balances, whether these have been satisfied for each class of transactions. The fourth type of test we will use are analytical procedures. As we discussed earlier, analytical procedures involve comparisons of recorded amounts to expectations developed by the auditor. Auditing standards require that we perform analytical procedures during the planning stage and during the completion stage. Although not required, these procedures may also be performed to audit an account balance. And essentially what we're saying is we perform these analytical procedures to give us sort of a warm and fuzzy feeling about the account balance. The 2 most important purposes of analytical procedures in the audit of account balances are to indicate possible misstatements in the financial statements and to provide substantive evidence. So again, they provide us the evidence we need in order to come to some conclusion about the fairness and accuracy of the financial statements. The final type of test is test of detailed balances. And these tests focus on the ending general ledger balances for both balance sheet and income statement accounts, although the primary emphasis in most tests of balances is on the balance sheet. Examples of these tests would include confirmations of the customer balances for accounts receivable, physical examination of inventory, or examination of vendor statements for accounts payable. These are essential because the evidence is usually obtained from a source independent of the client, which is highly reliable. So, a major part of the risk assessment procedure is to obtain an understanding of internal control. And it's important as auditors that we understand the controls in place, because we're going to rely on these controls, which will then inform us as to the level of substantive testing that we have to do, or we're not going to rely on them. And if this is a publicly traded company, not being able to rely on the internal controls, given the fact that we have to issue a separate audit report or perform a separate audit and come to a conclusion on the adequacy of internal controls with respect to financial statement reporting, becomes an issue for us. And so it's important to understand the internal controls in a company for these various reasons. And so this figure provides us with an illustration of the application of these 5 different types of tests to the audit of the sales and collection cycle. So in that cycle, and this is a business process that we'll speak to later, and we'll go through these types of discussions about each of the key business processes and how they're audited, we see that the process or the cycle is composed of the sales, accounts receivable, and cash and bank transactions. So we first audit the sales transactions and the cash receipts transactions by obtaining an understanding of the internal controls and then testing these controls for adequacy. The result of this testing and this understanding will inform the level of substantive tests of transactions, or this STOT, that we apply to these transactions. Once we've tested the transactions, we also will test the ending balances. For example, sales and accounts receivable will have ending balances. We'll perform analytical procedures on these ending balances in order to get comfortable with the balances and that they make sense with respect to balances in other parts of the financial statements. And we'll also perform tests of details of the balances. For instance, on accounts receivable, we'll actually confirm the detail amounts making up the ending accounts receivable balance. After having performed all of these tests, then we have reached our expectation of obtaining sufficient appropriate evidential matter, and based on a review of that evidential matter, the application of certain criteria to it, we'll apply our judgment and we'll come up with some determination as to whether or not these account balances are fairly and accurately stated. This table is meant to provide an illustration of the relationship between audit procedures and evidence. The further audit procedures down the left-hand side of the table we just talked about, and these are the tests of controls, substantive tests of transactions, analytical procedures, and tests of details of balance. So how do we apply those tests to classes of transactions or account balances? We apply those through the use of various types of evidence. And you'll recall we discussed the different types of evidence earlier. And these should be familiar to you when we talk about evidence gathering, such as physical examination, confirmation, inspection, observation, inquiries of the client, reperformance analytical procedures, and recalculation. Each of these are types of evidence that we use in reaching an audit conclusion. And so we can see under test of controls, we would gather evidence by inspection. We would look at documentation to see whether it was evident that a particular control was applied to that transaction. We would observe the application of the control. We would inquire of the client to understand whether they indicate the control is something that's valid, legitimate, and being followed. And we might reperform the control to make sure that we ended up with the same end result. Analytical procedures, you can see we get to by generally making inquiries of the client. Analytical procedures are the auditor's application of various calculations to various different account balances to look for different relationships. And where those relationships make sense, we're done with our testing. Where they don't make sense, we need to inquire from the client as to why or why not these tests, these analytical procedures, and the evidence obtained therefrom don't meet our expectations. And so now let's talk a little about the impact of information technology on audit testing. The auditing standards do provide some guidance for auditors of entities that transmit, process, maintain, or access significant information electronically. It's no secret that we are increasingly relying on information technology and computer applications and software platforms to assist in the processing of a significant number of transactions. This obviously becomes an issue the larger the organization. And so how do we balance being comfortable that the end results, that is the output of the processing, is correct without testing these significant volumes and volumes of transactions? And there are a couple ways that we're able to get to this level of comfort. We can use computer-assisted audit techniques which test the automated controls or data. And that is, we run data through the system with some preconceived idea of what the output would be, and we test the output to make sure that that the system processed it as we expected. We can also rely on reports by IT that can be used to test the effectiveness of IT general controls. And so again, we get back to this risk assessment. Does the computer department or the IT department require that programming changes be documented, approved in advance? Do they have to have significant testing before they're executed? What are the processes and procedures around the revision to a computer program? And that gets us to these program change controls. And then there's the usual access controls. So is it password protected? Do the passwords have to be some level, or can they be just any word that the user requires that doesn't, or the user would like, but it doesn't have any level of change associated with it? And these are sort of general controls that surround the entire IT system. And the more comfortable we are that these controls are significant, the more we're able to make use of computer-assisted audit techniques, the fewer substantive tests we have to apply to those transactions that are processed through the IT application. And so this table just provides us with an example of the variations in evidence mix. Under Audit 1, what we have is a large company with sophisticated internal controls and low inherent risk. So if we have sophisticated internal controls and low inherent risk, we can see we perform an extensive amount of testing on the test of controls, a small amount of testing on transactions, an extensive amount of testing on analytical procedures, and a small amount of tests of details of balances. And here we have a very efficient audit because they have sophisticated controls, there's low inherent risk to the business, and we are able to get comfortable getting comfortable that the controls are designed correctly and the controls have been implemented and are being executed to achieve their intended results, as supported by our analytical procedures, that the substantive tests of transactions and details of balances aren't necessary. In situation 2, we have a medium-sized company with some controls and a few inherent risks. And so there you can see that we do a medium amount of testing of controls, a medium amount of testing of transactions and tests of details, and an extensive amount of testing of analytical procedures. Obviously, if our tests of controls came back such that we had low risk with respect to the adequacy of controls, we would have to increase our substantive test of transactions and the test of detailed balances. Audit 3 is a medium-sized company with few effective controls and significant inherent risk. And that's what we just spoke to. So if we were to do our testing in sample 2 or audit 2 and the controls weren't operating as expected, then we would do no more testing on those controls, and we would do extensive tests of transactions and extensive tests of balances. And then we could rely less on the results from analytical procedures because we've confirmed the transactions and we've confirmed the balances, so that we aren't as reliant on analytical procedures as we would be otherwise. And then audit 4 is a situation where the original plan was to follow the approach used in situation 2. However, we find that the control test deviations and significant misstatements, while performing substantive tests of transactions and controls, were not effective. And so here, again, we do extensive tests of transactions and extensive tests of balances. So you can see that all of these tests inform one another. It's a very iterative and interactive approach to auditing. It requires a lot of judgment from the auditor, and it requires a deep knowledge and understanding of the client's business and the internal controls that are associated with that, as well as some level of understanding of the inherent risk associated with that business. And so this table kind of summarizes what we've talked to this point. What is it and how is it we design our test of controls and substantive test of transactions? And so we have to understand the internal controls that the client has. Based on our understanding of these internal controls, we have to assess some planned control risk. We test these controls to determine whether or not we can rely on them. We're informed by that testing to help guide us in the design test of controls and substantive test of transactions, so that we're able to meet the transaction-related audit objectives. And inherent to the design test of controls and substantive test of transactions are decisions surrounding audit procedures, sample size, items to select, and timing. And it's important to note here that for public companies, we're required to have an audit of internal control. Testing must be sufficient to issue an opinion on internal control over financial reporting. And as you all may recall from our previous discussion on the test of internal controls for financial reporting, we must issue either a separate audit opinion on the internal controls surrounding financial reporting, or we can integrate that audit opinion with the audit opinion regarding the financial statements taken as a whole. And so here we see this four-step approach to the design of controls and substantive tests of transactions. We have to apply our transaction-related audit objectives to a class of transactions. If we cannot rely on internal controls at all at this client for whatever reason, we go right to the design of substantive tests of transactions. What we've said by not being able to rely on these controls is that we have to test more detailed transactions, more detailed ending balance amounts, because we don't have controls that we can rely on. If we have controls, we have to identify what these key controls are and make some sort of preliminary assessment of the controls, and then we design tests of controls. And with any test of controls, we have to determine audit procedures, the sample size, the items to select, and the timing of these tests. After we perform these tests of controls, then we can use the information obtained from those tests to inform the decision on the design of substantive tests of transactions. And again, when we move into the test of transactions and ending balances, we're talking about what are the audit procedures, what's the sample size, what are the items to select, and what is the timing. And in this slide, we talk a little about the methodology for designing tests of details of balances. And here we're using the accounts receivable balance as an example. And as we spoke to earlier, generally, these details of balance tests refer to generally balance sheet accounts. So when we're getting and developing these tests, first we identify the client business risks that affect the accounts receivable. So there we would look at items like, well, are there a lot of closely related transactions? And if there are, perhaps we feel like we need to test more of those. Are there a lot of significant past due balances? And if there are those, then perhaps we would want to focus on those, and perhaps a confirmation wouldn't be solely enough to validate the balance. So by identifying those business risks, it still helps us to focus on the types of tests and the magnitude of tests that have to be applied to that balance. We set our performance materiality and assess our inherent risk for accounts receivable. We then assess the control risk for the sales and collection cycle. So are there good controls in place? Are transactions well documented? Are sales well documented? Is there good segregation of duties with respect to accounts receivable and cash collection? These types of tests help us to determine some sort of control assessment. Then we design and perform tests of the controls and substantive tests of transactions for the sales and collection cycle. So here we've decided what is the sample size. We've decided what are the tests we are going to apply. We've decided what are our audit procedures. And during this phase, we actually execute those audit procedures. Then we design and perform analytical procedures for accounts receivable balances. And that is, maybe we compare the accounts receivable balance or the change between years in accounts receivable balance with the change in years between cash, and look for some relationship there that meets our expectations. Or perhaps compare that change to the change in sales, total sales, and see if those relationships meet our expectations. If they don't, we inquire further of management. Then we design a test of details of accounts receivable balance to satisfy the balance-related audit objectives. And those objectives are items like the assertions made by management, such as completeness and cutoffs and accuracy. Again, when we're testing these details of the accounts receivable balance, we're dealing with audit procedures, we're dealing with the sample size, the items to select, and then the timing of those tests. With respect to timing, we might do interim work in September or October so that we don't have quite the rush, and given all the other audit tests that have to be performed on year-end balances, and then we roll those tests forward for the last quarter of the year. But we are able to come to some conclusion on those balances before we go into the significant time period where there are significant other number of audit activities going on based on year-end statements. And so this is just another slide, and it really talks to designing tests of details of balances for the accounts receivable balance again. And so here you can see the general types of tests that are done up front. Items like identifying the key controls and making an assessment of those controls with respect to control risk. Designing the test of these controls. Using the information from those to design the substantive test of transactions, and then to design the test of details of balances. And then from all of these tests and all of the different elements that inform these tests, we're going to make some sort of determination about whether the balance is accurately and fairly presented. And so you can see it's a very involved approach. This is just one balance, the accounts receivable balance, out of all of the balances on the balance sheet. Now granted, for most companies, the accounts receivable balance is a very material account, and so we spend a lot of time testing it and getting comfortable with it. But there's a lot that goes into testing some of these significant account balances, as illustrated by this slide. And this slide provides us an illustration of the relationship of transaction-related audit objectives to balance-related audit objectives. And as you recall, each of these audit objectives are meant to satisfy some concern around management assertions. And these management assertions deal with occurrence, completeness, accuracy, posting and summarization, classification, timing, realizable value, rights and obligations, and each of these assertions can generally be associated with either a class of transactions or a balance account balance. And we see that many of them have the same explanation. So for instance, with occurrence, if we're looking at a transaction-related audit objective, we're looking to see that, well, and if we're talking about sales, we're looking for auditing and testing that the sale actually occurred. If we're looking at a balance-related audit objective for existence or completeness, we're looking to see that the asset actually exists and that it's recorded at the correct balance. So we see there's a direct relationship between the occurrence transaction-related audit objective to the existence-related audit objectives. If a class of transaction increases, the related account balance. There's a direct relationship of the occurrence transaction-related audit objective to the completeness balance-related audit objective if a class of transactions decreases the related account balance. And so this is just meant to illustrate those types of relationships between these two. And in this slide, we talk about the relationships among 5 key evidence-related terms. And when we talk about the phases of the audit process, we're talking about the planning and design of the audit approach, the performance of tests of controls and substantive tests of transactions. Phase 3, which is to perform the analytical procedures and test of details of balances. And then phase 4, which deals with completing the audit and issuing the audit report. Attached to each of these phases are certain audit objectives. So for test of controls and substantive test of transactions, we're really testing for transaction-related audit objectives, which means testing the occurrence, completeness, accuracy, classification, and timing assertions. When we perform the analytical procedures and test of details of balances phase, we're talking about balance-related audit objectives, which include existence, completeness, accuracy, classification, cutoff, realizable value, and rights and obligations. And then when we're talking about completing the audit and issuing the audit report, we're talking about the presentation and disclosure-related audit objectives, including occurrence and rights and obligations, completeness, accuracy, and valuation, classification, and understanding. And then again, related to each of these phases and audit objectives then become the types of tests we talked about. So are we using analytical procedures? Are we testing for details of balances? Are we testing for details, substantive tests of transactions? Are we performing procedures to obtain an understanding and test of internal controls? Then we get to the evidence decisions. And of course, as we talk about all of this testing that's being performed, inherent to all of that are decisions surrounding the audit procedures, the sample size, the items to select, and the timing of when we perform those tests. And then finally, we talk about the types of evidence. And here we talked about those at length and throughout the course. We talk about items like inspection, inquiries of client, analytical procedures, reperformance, observation, recalculation, and physical examination are some examples of that. And so you can see that each of these, whether it's the phases of the audit process, the audit objectives that are inherent to those phases, the types of tests that help us meet those audit objectives, the evidence decisions that inform those types of tests, and the types of evidence that we confirm as a result of the evidence decision are all very much interrelated, and they're very interactive, and they inform one another. So what we realize through the evidence decisions may change the types of tests that we perform or the types of evidence that we find we need to validate and to become comfortable with the audit objectives. So it's a very interactive and integrated approach. And we talked about this briefly on the last slide, where we really have the different phases of the audit process. We plan and design an audit approach. We perform the test of controls and substantive test of transactions. We perform analytical procedures and test of details of balance, and we complete the audit and issue an audit report. And of course, in phase 1, the plan and design of the audit approach, we think about and talk through accepting the client, and we perform initial planning. We understand the client's business and industry. We assess the client's business risk. We perform preliminary analytical procedures. Based on that, we set materiality and assess acceptable audit risk and inherent risk. We understand the internal controls and assess the control risk. We gather information to assess fraud risk, and we develop an overall audit strategy and audit program. Then we move into phase 2, where we said we perform tests of controls, we perform substantive tests of transactions, and we assess the likelihood of misstatements in financial statements. In phase 3, this performance of analytical procedures and tests of details is where we're looking for these relationships that we expect to exist. If we find that they don't exist or that they are different than what our expectations were, we inquire of the client, and we test these details of balances, particularly with respect to the balance sheet. Then we complete the audit and issue an audit report, and completing the audit also requires a very complete set of steps that include, which are required, the regulations or the standards require that we perform analytical procedures, and we also have to evaluate the going concern concept that we spoke about earlier, and we're concerned here with the presentation and disclosure. And then based on that, we decide what type of audit report. And if you recall, we had the types of audit report were qualified, unqualified, disclaimers, or adverse. And so all of these phases together represent the audit process. And so as a brief reminder, with respect to audit objectives, we have transaction related. That is, if we think of sales, all of the different sales transactions we're testing to determine whether or not revenue or sales is fairly stated. We talk about balance related, and so there we're generally talking about auditing the balance sheet accounts, and so we're looking at accounts receivable, and we're trying to decide whether or not the balance is fair, and we're doing that by testing specific outstanding invoices and perhaps specifically testing paid invoices. And again, we're trying to always get back to these management assertions with respect to balance sheet accounts, such as completeness and accuracy and timing. And then we're testing this presentation and disclosure related objective, particularly by looking at the footnotes to make sure that they are accurate and fully reflect any kind of additional information that would inform the financial statements. As just a quick refresher, we talked about the types of tests: our risk assessment procedures, tests of controls, substantive tests of transactions, which are informed by the test of controls, analytical procedures, and then tests of details of balances, which are informed by the test of controls as well as the results of the analytical procedures. When we're talking about evidence decisions, we're talking about the audit procedures. So what are the tests of the specific transactions or balance sheet related support? How much of the transactions or balance sheet balance do I need to test? What items in each of those situations do I need to test, and when do I need to do this testing? A good example of timing would be something like inventory. Companies with material amounts of inventory must do year-end inventory, and so what is the right timing? Is there some interim testing that can be done on inventory balances, or does it all have to be, and then that the results of that interim can be rolled forward and it can reduce the amount of substantive testing, the amount of physical examination, the amount of observations that we do, or is there none of that that can be done in interim and we have to be on hand to observe the physical count of inventory? These are all the decisions that come that have to be made and that come about as a result of our reliance on internal controls and the various steps we've talked about in the audit process. I remind you again about the types of audit evidence, and we talked about this in a previous session, but we talked about evidence that's comprised of inspection, physical evidence, recalculation, reperformance, observation. So we observe the physical count to make sure that there are controls around the physical count of inventory. There are analytical procedures where we're looking for expected relationships, and if they aren't there, we inquire of management. Confirmation of account balances, for instance, accounts receivable, which we are required to confirm, and then inquiries of clients, which provide us with a narrative and with additional information regarding our testing that may cause us to perhaps need more physical evidence, provide more or calculate more analytical procedures or more recalculations. And so these are all the different types of evidence that we talked about in a previous section, and this is just a reminder of that. And so here again, we're just going to review that in phase 1 of the audit process, we plan and design the audit approach. In phase 2, we perform test of controls and substantive test of transactions. And these were the controls that we developed an understanding of during phase 1. And along with that understanding, we also assessed our inherent risk and determined what an acceptable audit risk was. In phase 2, we perform analytical procedures and test of details of balances, that is generally balance sheet accounts, and in phase 4, we complete the audit and issue an audit report. And this is just meant as a summary of the audit process and the important steps in it. And so in phase 1, where we plan and design the audit approach, we're talking about decisions to accept the client and performing initial planning. We need to develop an understanding of the client's business and industry. We need to assess the client's business risk. That is, how likely are they to achieve their business objectives, which we said is different from audit risk. And we also perform preliminary analytical procedures. We further then based on the results of this, we set our materiality and assess our acceptable audit risk, which is, we discussed audit risk, and it's the risk that we will issue an audit opinion on financial statements that are not correct, and we say that they are correct. And we talked about inherent risk, and that is just what level of risk can be associated with this client's business. We understand the internal control, and we assess control risk. We gather information to assess fraud risk, and then based on all of this information and evidence at this point, we develop the overall audit strategy and audit program. During phase 2, we have to make a decision. So we plan to reduce assessed level of control risk, and if we do, then we have to perform tests of controls. If we don't, then we perform substantive tests of transactions, and we assess the likelihood of misstatements in the financial statements as a result of those tests of transactions. During phase 3, we perform analytical procedures, and the extent of these analytical procedures deals with the decisions that we reach during phase 2 of the audit. We also perform tests of key items, and we perform additional tests of details of balances. And then finally, in phase 4, we perform additional tests for the footnotes, essentially, or the presentation and disclosure. We accumulate all of the evidence that we gathered in the prior 3 phases and in the first step of phase 4. We evaluate these results, and again, we're independent, we're objective, we're impartial, we're applying the standards and criteria of the industry, that is generally accepted accounting principles, to this evidence. We evaluate them to determine whether the financial statements taken as a whole reflect fairly the results of operations of the organization. We issue our audit report, and then we communicate with the audit committee and with management. And so having gone through all of that, I would welcome any questions or any parts of the lecture or your readings that are not clear to you. I encourage you to please log on and submit these through the chat feature or through any discussion forum that we may have. Thank you for your attention, and I encourage you to go back and read this chapter closely because it's an integrative chapter. It's meant to pull together a lot of the things we talked about earlier, and so I would encourage you to read this chapter closely and make sure that you have a good understanding of it because it is critical, obviously, to the auditing discipline. Thank you.